Let me ask you something. If you keep $10,000 in cash for the next 10 years, will it be worth more or less? Most people don't realize this, but because of inflation, money that just sits in a bank account slowly loses its purchasing power. That's why in 2026, investing is no longer optional. It's necessary. Why investing matters. Inflation quietly eats away at your money every single year. In the United States, inflation averages around 3 to 4%, and during some years, it can be even higher. So if your money is only sitting in a checking account, you are effectively losing money without noticing. Investing isn't about getting rich overnight. It's about protecting your future and letting your money work for you. The core investment options. A smart investor doesn't rely on just one place for their money. Let's break down the 5 major investment options every beginner should understand. SafeBase. Savings and CDs. High-yield savings accounts and certificates of deposit form the safety net of your finances. They don't make you rich, but they protect your money and give you peace of mind. This is where your emergency fund and short-term goals belong. Stock market. Long-term growth. The stock market is the main engine of long-term wealth. For beginners, index funds and ETFs are the simplest way to start. By investing consistently every month, you take advantage of long-term market growth and the power of compounding. Historically, the U.S. stock market has delivered strong returns over long periods of time. Retirement accounts. Tax advantage in the U.S. Retirement accounts are extremely powerful tools. Accounts like a 401k or a Roth IRA allow your investments to grow in a tax-efficient way. If your employer offers a 401k match, that's essentially free money you shouldn't ignore. Gold. Stability and protection. Gold isn't meant to grow aggressively. Instead, it acts as a hedge during uncertain times and helps stabilize your portfolio. A small allocation through gold ETFs or digital gold can add balance to your investments. Crypto. High risk, high potential. Cryptocurrencies can offer high returns, but they also come with high risk. For beginners, it's safer to focus on large, established assets like Bitcoin or Ethereum. Crypto should be a small part of your portfolio, not the foundation of it. The power of compounding. Here's where time makes the biggest difference. Even investing a few $100s per month can turn into a significant amount over decades. The earlier you start, the more compounding works in your favor. Time is more powerful than timing. Age-based investing approach. When you're younger, you can afford to take more risk for higher growth. As you get older, your focus should slowly shift towards stability and capital protection. Your investment strategy should evolve with your life, not stay the same forever. Important rules to remember. Never invest in something you don't understand. Market ups and downs are normal, panic is optional. Diversification reduces risk, and patience builds wealth. Final message. You don't need to start with a large amount. You just need to start. In 2026, the biggest financial risk is doing nothing at all. Start early, stay consistent. Let compounding work in the background. Your future self will thank you.